Zdravo, zdravo. Cool, thanks for your time. As you said, my name is adcv, and I've been diving deep into staking and restaking over the past couple of years, as our company has been the finance work stream for Lido since 2022. And I wanted to go over a few key points from some research that we did to try and understand what restaking was, and hopefully provide a novel perspective to help people understand it. We work with a bunch of different projects. I spend most of my time on Lido. And what we tried to do was bring our TradFi backgrounds to try and understand restaking as sort of TradFi small brains, and to explain things from a first principles perspective. The paper is available on our website, and we also have an associated June dashboard on the following links. And on this presentation, I wanted to go over sort of 3 points. Firstly, to describe what is a crypto economic network, or an actively validated service, or AVS, and provide a mental framework for how you should think about the unit economics of restaking, and talk a little bit about what the market expectations are looking like at the moment. And so some of the takeaways that you can take away from this presentation are that, well, firstly, Ethereum and proof-of-stake systems create this system of sort of collateralized crypto economic security, and restaking extends that further by creating a marketplace for that trust. However, we find that restaking is still not quite ready for prime time yet, and is still in very much active development. And it's not clear from a market perspective that the amount of capital that's committed today will be sufficient to load bear the expectations for restaking yield from these services. And then finally, we provide a sort of heuristic way of calculating the return on trust. Similar in TradFi, you have a concept of return on equity, and you can have a similar type of framework for return on trust in crypto. So to start on the different questions, a crypto economic network, also known as an AVS in crypto jargon, or an actively validated service, you can think of Ethereum as an AVS, the first one in our ecosystem, where it uses crypto economic incentives to allow transactions to settle in a decentralized way. So you need this amount of security to allow the network to execute these transactions without depending on a single counterparty. And putting yourself in the shoes of an investor looking at the Ethereum landscape, a useful framework is the one of total return, which is borrowed from TradFi, and we've sort of turned it around and applied it to crypto, where total return has a price. Total return is the financial return from your investment in an asset over a random time period, let's say 12 months, and you can decompose it into price return and work yield. The price return component is a function of the change of earnings of a network, the multiple change, which in crypto we call narrative, and the change in supply of the underlying tokens. And where work yield is the staking issuance, and in this instance, which is dilutive to ETH holders. You can actually decompose the total return for Ethereum in a very neat way by, it's a tautological formula similar to like the Dupont model, if you are familiar with it, where you just sort of add the denominator and the numerator, so you break it out and break it up into different components. And we have this dashboard on our June page that shows the evolution of these different factors over time. And what's interesting is that the sources of total return vary for a network depending on its level of maturity. So for Ethereum, at the moment, you can see that multiple growth is a big driver of total return. So how people are thinking about Ethereum overall relative to other crypto assets and relative to other assets overall. The reason this is important to keep in mind is because creating a new crypto economic network from scratch, the way that Ethereum did it, for example, or Bitcoin or what have you, can be very expensive, because at the start, there's a balancing game where you need to attract new users, but the users won't come if they believe that the network is centralized and their transactions won't settle in a disintermediated way. And a useful proxy actually is to look at Cosmos mini chains in the IBC ecosystem, because the net issuance is not a perfect proxy for states of decentralization, but it's a useful signal. And you can see that many of these Cosmos blockchains that require validators are having to pay an enormous amount of capital to subsidize the activity of the network and to bootstrap these network effects. Whereas Ethereum at the top is in a position of maturity where it can afford to burn some of these and have a negative net issuance. Decentralized security relies on a diversified group of node operators to avoid capture by any one entity. Even though proof of stake has very strong centralizing aspects to it, to its design. Here, you'll forgive me for shilling the project that we work for, Lido, but you can see that Lido has been very successful at using this market force for centralization and turning it around and making it into a force for decentralization instead. By sort of rate limiting the growth of any one node operator, Lido actually contributes significantly to an improvement in the concentration of Ethereum validation, which you can see in the line graph on the top right, which is a measure of sort of market concentration with and without Lido. And the TLDR is that it would be a lot worse without Lido. And so that's so much for staking. Now, moving into restaking, we can sort of wrap this up by summarizing that restaking is basically one of the options on a buy versus build consideration for a new crypto economic system where you can build something, and the advantage is that you can end up with a sovereign chain. If it works and you end up with something like Ethereum, you have something that's very valuable because it's decentralized. On the other hand, it's very expensive. You need to bootstrap this. And you have this sort of cold start problem where you need users, but the users won't come if the validators aren't secure, and the validators won't come if there are no users. In restaking, the idea is that you can rent this security instead and shortcut it completely. So instead of having to do the capex of doing a big token inflation, you can pay a restaking fee to restake the capital that's already secure. The pros/cons is that you don't have security of your own, but you inherit it from the security that you rent. So if you inherit it from Ethereum, it's quite secure. And from a financial perspective, we like to think of things in terms of balance sheets at Steakhouse because that's just how we're wired. And I think that they're quite useful models for thinking about things in general, where you have three different analogies. The first one is a typical company where you have on the left-hand side assets, and on the right-hand side you have liabilities and equities. So it's like uses and sources. And in Ethereum, you can make a similar analogy, and with the caveat that this is an imperfect analogy, so it's obviously not suggesting that Ethereum is a company or a security or anything like it. But you have this concept of sort of preferred with the recipients of the work yield and ordinary holders. And in an AVS, you extend that further where we consider that restaked capital is a type of liability or senior debt because it takes the first claim to the restaking fees before anyone else. That's the theory, anyway. And the security that it gains can be capitalized on the other side of the balance sheet because it provides tangible benefit to users who know that they can trust an AVS because it's secured by Ethereum. Now, at the moment, the landscape of restaked networks is very emergent. This is one taxonomy that we propose in our paper. It's not, complete or perfect, but it's sort of what the paper had at the time. More networks have emerged since. There will probably be even more, and very likely that there will be some sort of Darwinian selection as some of these networks test the waters and realize that they can't survive on their own. But we see things sort of as like blockchain utilities, roll-up utilities, and application utilities in different levels of abstraction from the underlying blockchain. And this is relevant because it helps inform how we think about the business model of these networks. So in this graph, we have from left to right, we move from native ETH to Lido staked ETH to restaking that pays in hard tokens, ETH or USDC, to restaking that pays in more volatile tokens, to the points, basically. And you can arrange these sources of return in relation to, in the different colors, you have the price return, the work yield with the consensus and execution layer rewards, and then you have a new source of work yield, which is the restaking component. And as you go up in risk, you go up in variability. So we have this sort of, price return all the way up to maximum variability, with the points being the most uncertain of the whole stack. And our point is that networks or AVSs should be evaluated like infrastructure businesses to determine whether they have the ability to maintain enough security to function safely and deliver enough restaking fees to make it interesting for the providers of capital to secure it. So we come up with this concept of a restaking operating affordability ratio, which is the acronym is ROAR. And this is taken, again, borrowed from TradFi, which has a concept of a debt service coverage ratio that investors look at when choosing to invest in a company to see whether a company has over-leveraged and taken out too much debt, and whether that poses a risk to their investment in the equity. And in a similar vein, a restaked network can be over-secured or under-secured. So it can be paying too much or basically have too much capital for the amount of yield that this capital expects, or it can be under-secured and not run safely enough for its users. And we have this sort of balance. So adding all of this up gives you a useful framework to start from. So you have a sort of fictional network balance sheet where you have the assets and the amount of restaked capital on the top part. And you can draw out what the required return to restake is on the x-axis. And you can work backwards from there to see how much fees a network has to generate in order to deliver this level of restaked return to providers of restaking capital. And you'll notice that we have big numbers here, 5, 10, 15, 30, and so forth %. The implied AVS cash earnings are on the order of magnitude of the entire Ethereum network. So when someone says even 4, 5, 10% restaking yields, this is enormous and would require AVSs to be extremely successful at generating fees. And what we found in our paper, apologies for the sort of word-dense slide, but to summarize, we wanted to try and triangulate what the market potential was for restaking fees in any given network. And we looked at sequencer revenues for rollups and sequencer profits. And we found that on the current base of all the restaked capital that exists at the moment, which is about 5 million ETH, if 100% of sequencer revenues went to restakers, the yield calculation would output 4%. If 100% of profits accrued, it would be 1.5. And if you took some random sort of feasible sounding number, like 20% of profits, it would be less than 1%. And I think that's probably, at the current level of restaked capital, I expect real restaking yield to probably be in that order of magnitude. So what this says about the market expectation for restaking at the moment is that there's a lot of capital that's expecting to secure not a lot of restaked networks yet. Now, granted, this can change if, for example, the amount of restaked ETH decreases a lot, the fees go up in percentage terms, or if there's some new use case and utility that emerges that someone invents, then and that can afford it, then obviously the fees can increase as well. If we want to triangulate what the market expects, we don't have a lot of signals, but we do have the price of a point. EigenLayer has raised a significant amount of capital on the back of its points campaign, which was a very clever way of promising points in exchange for a significant amount of ETH. And this gives them the luxury of being able to calibrate exactly how much that token issuance would cost them, ultimately. And the way that we found to estimate what this implied APR is with a tokenized point. So it sounds a little bit absurd, but there is was a concept of a tokenized EigenLayer point in a token called KEP. And this token traded on DEXs. And you could backwards imply what the implied APR was. And it was in the order of, or still is in the order of sort of 30 to 40%. And since then, KEP has depegged, because it's a stable coin on EigenLayer points, and it didn't have withdrawals. So, shit happened. They announced the token, it depegged, it was wild. And then, but I think that this gives you, the point of this slide is to give you a sort of idea of where the market was expecting at some point restaking yields to end up in, which in our view was a little bit overshot. And then to touch on liquid restaking tokens, which is one more layer of securitization and abstraction on top of restaking, the idea is that a lot of networks will emerge. It will be very difficult to parse what they are and what they do. And liquid restaking tokens will play the role, something like a fund manager or a money manager. And they will do the underwriting and curate these networks and select the ones that their users would allocate to. Moneyness is not, they're called liquid restaking tokens, but we don't feel that moneyness is necessarily as big of a feature for LRTs as they are for LSTs, because if they are sincere in their curation, they will all end up looking a little bit different and provide a slightly different risk and return profile. In our sort of small IQ perspective and way of looking at the world, the way that we see LRTs evolving is that you should look for their ability to underwrite, the quality of the collateral, and the idiosyncratic risks from their particular design. And here is sort of a schematic of how a arbitrary LRT could be set up with one or more different types of restaking platforms. The other point is that native staking is actually way harder than people think. A lot of these LRTs that launched with native staking features are finding that having to run staking to begin with is very difficult. Restaking, by virtue of the smaller amount of node operators, is having a centralizing effect on Ethereum validation at the moment, unfortunately, though trends can reverse. And so our expectation is that eventually people will, LRT managers and designers will eventually conclude that using staked ETH as the underlying collateral will prove to be a source of competitive advantage and will let them focus on curation, quality of collateral, and idiosyncratic risk management. And then to touch on finally on the risk aspect, this is an illustration of why restaking is still very early stage, because the risk absence is, other than sort of smart contract design for restaking middleware at the moment, it is completely fugazi, like it doesn't exist. There are no slashing conditions yet. So from a common sense perspective, we can imagine that once these slashing conditions become public and they start going live, you can imagine that they might have a correlation between infrastructure providers. A lot of these networks are basically doing slightly different flavors of the same thing, and a lot of them will therefore likely be quite correlated, which will imply some kind of a diminishing return curve on effective yield after accounting for risk. And we also consider that multiple turns of restaking probably adds more risk, and that some networks will inherently be riskier than others to validate for. There may be some networks that are quite straightforward and don't add a lot of risk. Pre-confirmations are one example that come to mind, but others could be potentially riskier. And I just want to touch on pre-confirmations, because the restaking landscape, we talked a lot about sort of the grounding or the coming down to earth experience that we had looking at the restaking landscape, and it's not all sort of cynical. Like, there is a lot here to like. Restaking is very, very promising as a way of scaling Ethereum's ability to sort of become the base layer for more things, which I think is a good thing. Pre-confirmations is an example of a valuable service. We liken it to, we feel it's sort of like MEV boost. Nobody thinks about it anymore, but it's a quasi AVS that a lot of validators run already and perform a very valuable service for all of the users on Ethereum. And pre-confs will be similar for L2s in terms of like accelerating transaction latency and what have you. And these are real tangible benefits that very likely have a real business model behind them as well. But to close, like, restaking, especially from an institutional perspective, is probably nowhere near a state where institutional capital could or should touch it. Non-crypto native capital allocators are still figuring out Bitcoin, and eventually they'll figure out Ethereum, and eventually they might get comfortable with staking. But restaking is on a very much pre-alpha experimental stage at the moment. There's no risk or slashing conditions, which suggest that there's a way to go still. And there are certain centralizing and discretionary elements that make restaking platforms and services look a lot like regulated financial services, which is likely going to be a dissuasive factor for institutional adoption. And with that, sorry, I just rushed through a lot of things, but yeah, please clap. Thank you. Are we good on time? Okay. I don't know if anyone has any questions or you guys are satisfied with the presentation. If not, thank you very much. Hola Puno, and have a nice day.